it's been kind of like a typical thing in the projections that trillions of assets will move on chain in the next couple of years. But for this panel, I want to cut through that hype and want to ask guys from each of your perspective on VC side, asset allocator and so on, that is the infrastructure ready for prime time? And what are the pain points if not?
Okay, yeah. I think for the last 3 years when we were building block tower credit along with Centrifuge and the teams, the answer was definitely not. So I think in order for this technology to work in a meaningful way, and what I mean by that is like it actually allows a financial institution to create better unit economics. You need to use the blockchain as a canonical ledger for assets, payments, and ownership. Like, full stop. There's no way to, take in custody information from DTCC, be a glorified Oracle / middle office, and then, plug the data into a digital twin on the blockchain, and then have that be cheaper than not using the blockchain. So one of the critical aspects of that, I think, is the stablecoin infrastructure, obviously, and the fungibility with existing payment rails. Obviously, I don't need to get into this, but I think that is materially different today than it was when we were building, our first versions of, honestly, on-chain, like private credit, on-chain consumer lending banking. And for us, this is a huge unlock. Like, I do think that we're in a different world, but I'll pass it over to these guys first.
Yeah, no, I think I echo that, right? We have some great V1 primitives. We've got on-chain treasuries, other products. Those have gotten a lot of adoption with traditional crypto actors. We're probably missing a couple bits and pieces for the ecosystem to go prime time. I think of a couple. We've talked about this one a little bit in our prior conversations, but custody for tokenized real-world assets is egregiously expensive. When you compare it to like TradFi custody for traditional off-chain assets, that seems like a potential big blocker for a portion of the institutional world. Other examples include how do we attract traditional TradFi capital into tokenized assets? Right now, the demand's coming from DAO balance sheets, crypto native funds. For a lot of traditional credit funds, in order for them to invest in some of the assets that the folks in this room are representing on chain, they might need insurance. They might need bits and pieces of the ecosystem that have yet to work with crypto native issuers. So it feels like both in infra and in kind of operations, there's still a lot of work to do, particularly as real world assets migrates beyond T-bills to other asset classes.
Yeah. And I think when we think about infrastructure, we need to think about it in a more holistic way, right? From a product and tech stack, I think we're there. But I think the surrounding pieces, things like the finance piece, the compliance piece, the assurance, the legal, I think a lot of that is still not in place for us to really scale that. I mean, here's a case in point, right? For our fund, we are born out of a regulated financial institution. And the first time when we dabbled in digital assets, one of our auditors, or rather our auditor, said that if you touch digital assets, we will stop auditing the entire group, which is kind of draconian, right? And so really, if you think about that, for this to really take off, we need the supporting ecosystem to really come on board and be ready for that. Are we there yet? I don't think so, but I think soon, and there's a path towards it.
Okay. There's been a couple of pieces to drill into. So let's start with the building on the VC side, because if it's legal and compliance, it's not something that you can, even if it's infrastructure, it's pretty hard to build a company around it probably. But you have a new fund, you are obviously investing in a lot of startups. So what kind of pitches you are looking into? What type of infrastructure pieces you deem investable and bring returns and really adds value to the industry and bears towards that trajectory that traditional finance will come on chain at some point?
I think what we really like is where startups have that unfair advantage when it comes towards partnering with legacy institutions, with existing trusts and existing networks. One of the things we have learned somewhat the hard way is that it's really hard to bootstrap trust, right? When you launch a product, if you truly want to get mass adoption, you want to get retail people to get it, it's just really hard to convince people to part with their money. I come out of Asia and there's a lot of that trust, there's a lot of the legacy thinking, and I think that's really where people don't want to take risks with their capital. So what we like is where there's the infrastructure that is easily sort of plugged in to existing networks, existing legacy institutions that carry that trust, carry that customer networks. That's what excites us.
Yeah, I feel like as a fund, we've placed a lot of bets, actually in a lot of companies that are represented at the summit. So thank you, RWA Summit. We're investors in things like Centrifuge, Maple, Midas, sort of like the issuers of tokenized assets, the folks that are taking these off-chain assets and putting them off-chain, and you will. We've started to also invest in things like the liquidity layer, I'll call it, things like Morpho, things like Ether9 Maker, which play into the liquidity equation because they're large customers of these tokenized assets. We're now less looking for what I'll call those V1 primitives, less issuers, less liquidity venues, more ancillary pieces of the ecosystem, things like credit scoring, if that ever works on chain, things like insurance, if that ever works on chain, sort of these V2 primitives that we think are important to kind of grow the market as opposed to the local, perhaps not ceiling we found, but product market fit level we found, which is in the orders of low tens of billions, but potentially not hundreds of billions. So starting to look for kind of what comes next. That's also coupled with like product shift, again, from T-bills into bonds. Stocks, I'm sure, is a big topic today. So just some of the things on our mind and some of what we've done in the past.
You mentioned insurance, and there's been quite a few trials with that. Why didn't happen? Why didn't work?
I am
What was
not
the
the
roadblock?
right person to ask that question.
Yeah, I would say like on-chain insurance providers like Nexus Mutual, they struggle. I mean, they've been a huge success, but I think part of it is it's very difficult to underwrite like correlated risk. Mm-hmm. So if there's some sort of like supply chain hack, like that's probably affecting multiple protocols at the same time, and if that's like the exposure for their like liabilities, like they're all correlated, and so they have to price at pretty extreme levels to make up for the possibility that they could lose their entire treasury on day one. And then I think the other side of it too is more of a token design like issue. Like at this point, I think everyone understands like tokens are some mix of like utility, but then for a lot of people a pure grift. And on the like latter side, one of the reasons that the tokens like work is because there's a lot of volatility. And in something like Nexus Mutual, where the balance is tied to a portfolio of like, $184-ish million of like, dollar value, there's an anchor that suppresses the volatility of the token itself. And so it becomes difficult to like, get new investors into the pool, grow the pool of the, deployable dollars via insurance. And then also it's difficult to underwrite the insurance because how do you assess beyond even just like protocol or the smart contract level risk, the financial risk that the protocol is taking, the managerial risk of like, one bad actor in the multi-sig walking away. So I do think it will be figured out. I think on-chain insurance programs will like continue to grow. But the real money will come from, traditional insurers that can have this be one part of a non-correlated portfolio and drive down the cost of insurance.
Yeah, I think from an uneducated perspective, we're interested in seeing more off-chain traditional insurers move into crypto. There's been very little, and it's been segmented to like Lloyd's working with BitGo, basically. We're also looking for maybe more purpose-specific crypto-native approaches to insurance. Things like Nexus were very general purpose, looking at a lot of variables. I think in the real world, insurance tends to be specified. To price that kind of risk, you have to go pretty specific. So those are kind of the two ways, both top down and bottom up, that we're kind of paying attention to.
Both of you mentioned costs that token, like you mentioned, Thomas, the custody costs. Kevin, you mentioned because of the volatility. For me, from the outside reporter perspective, that means cost usually means friction. So what should the crypto industry do to help drive down those costs and make handling, in a broader aspect, handling tokenized assets cheaper and more competitive with off-chain assets?
I feel like you started saying it.
Yeah, go ahead. Yeah.
Well, maybe I could take a stab at it, right? I would slightly disagree that I don't think it's the role of the crypto or blockchain industry to drive these costs down, because the costs don't come from there. The costs come from the other players who perhaps don't understand or are not crypto native the likes of, once again, your auditors, right? Yeah, your lawyers, right? A lot of these are still actually bound to very traditional models like hourly charge, right? You pay someone $1,000 an hour to give you that advice. I think what really helps is two things. One is regulation. When regulation is clear, then you have a proper checklist. You tick off the checklist, you're good to go, right? The problem comes when the rules are not defined, then it's just like an unlimited, like how much risk are we allowed to take? How compliant can we this be? Then we just go on this infinite journey. I think that's one piece. I think the second piece is just building comfort, right? What we see is these people, like let's just say your rating agencies, your auditors, many of them are still uncomfortable signing their name off many of the products that we look at in this space. And I think that's the fundamental problem. We need to build comfort where this is no different from an off-chain asset, and perhaps they see there's even more benefits from there.
Yeah. And I think, I guess like maybe less from a pure infra play, but just like how you would build a business model that drives down cost. Like Stripe is, currently putting on a master class of saying like, we own merchants, we own, actual like point of sale payments online. Everything that sits in between in the Visa network, the acquiring banks, the issuer banks, like those go, like that's where the cost is. Like Visa takes a 3% interchange like fee, 270 some odd basis points of that goes to the intermediaries. And Stripe is saying, all right, well, there are all these like intermediary waypoints that we can completely disintermediate by having an on-chain like address like solution, which is why they bought like Privy or wallet solution. Bridge, obviously the orchestration of the stable coins and the infrastructure to spin up your own stable coin, and then building Tempo, which is, like the actual like transaction, like blockchain. If you have those and you have the two endpoints, then theoretically the cost of moving money from one to another on a different rail other than Visa and ACH is however much the unit economics of that will be, which is probably, gas plus, a few dollars per wallet or something like that. You need to have somebody be really ambitious end to end to like basically disintermediate everything in the middle. Obviously that's difficult because those intermediaries exist for a reason. They exist to capture customers, to capture merchants, to deal with compliance. So like it's very difficult for very tiny, thin projects in crypto to add a ton of value because they have to go and enter into this fray of intermediaries. But I think the next wave of companies, both because there's more ambitious VCs out there, more ambitious founders, but then also like big corporate players who are also starting to see this technology as a way to like drive superior unit economics. Like I think they will drive the next wave of materially lower costs in the industry.
Yeah, it comes down to scale and eventually maybe not having off-chain and on-chain assets, but being able to issue the bearer version on-chain directly, right? You cut out a lot of the costs there. It's interesting to know though, all the traction this space has gotten has been despite the costs. Like we have DAOs ingesting TradFi assets and accepting a lower rate than they would get off-chain just to be able to do it on-chain. Kind of showing that there's demand from just like an access perspective, despite the cost, at least on-chain. We're seeing something similar with tokenized stocks, right? Tokenized stocks are objectively more expensive than non-tokenized stocks. As a US buyer, I'm probably not inclined to go and buy them on-chain unless I want to use them for collateral, something in DeFi, or unless I'm not a US buyer and it's an access thing where, maybe I'm from like the Asia or Middle East region and this is my best access point. So costs haven't prevented this industry from scaling to the billions of dollars. We'd like for them to compress. It probably takes some scale, some regulatory mix, but yeah.
What we haven't touched on, and that's a great way that you mentioned Stripe and Tempo. I want to piggyback on that because there's a question that there's always like conflict between permission and permissionless. And to be able to onboard traditional finance giants to on-chain rails, it's one of the main, probably the first concern that it's a permissionless. I don't know who I'm interacting with. So how do you envision how it will play out? This one, we will have like permission silos in the next few years, or there's a way to make it more modular, piece by piece? interacting with each other, which direction we are heading, which we have to think about.
So I feel like the whole point of doing this is ultimately to get to permissionless, right? If you do permission, then you kind of you might as well just use an AWS server. But I think it's really going to be a phased approach, and that's what we're seeing in places like Singapore, like in Brazil, where the regulators themselves are coming up with their own private blockchains, and then they say, hey, if you want to do anything, you want to tokenize an asset, you come to our private chain, right? And then obviously at the start, it doesn't make sense, right? It's like, why would I go through all of these hoops? But once again, I think it's all about building comfort. And then from there, we hopefully get to the next step, which is really getting out there to the permissionless world, right? I think what is making a lot of regulators and even TradFi very uncomfortable is the fact that if today you have to put your assets natively on your permissionless chain, that is just something that's very discomforting. And we have to remember that these are multi-billion-dollar businesses that exist outside of blockchain. Would you want to risk your cash cow for this experiment over here? The answer is no, right? So really, I think it's going to be step by step.
Cool. One question, and it's related to that. So for the teams who are building and the companies who are focusing on real world assets, what should be their priority? Reaching a wider distribution or being more efficient and being faster and finality?
I mean, I think it's definitely distribution. Like, as much as I like to talk about operational efficiency and unit economics, because like over the long term, I think finance is hyper rational. Like, if you can buy the same asset and have a higher net return, like generally the money will move in that direction. But that's not gonna get you off the ground. You're not going to be able to sell that credibly, at least not that I've found so far. So it is distribution. I mean, as an example, like at Steakhouse Financial, we run kind of like Aave-like instances through kind of our Morpho vaults. And we have just built a big partnership that I think is public now, or at least will be public this week, but I'm going to talk about it right now. Where if you're in the Coinbase app and you have USDC, and if you want to earn more than 4.1%, the USDC rewards rate, you can click a button and you'll opt in, you'll automatically deposit into the Steakhouse Financial Vault. So for us, we've been very focused on distributing to where the end customers already are, because to offer a digital asset money market fund, which is effectively what these vaults are, as a standalone product is not that attractive. It's better as a feature in the context of like a crypto super app, which is really what Coinbase, Robinhood, and all of these guys are trying to do, where you lend, borrow, earn, trade, deposit, save, all of those things on one app. So I think we'll see. Obviously, like we've made a big bet on this distribution angle being really meaningful, and we believe it will be. But I think like those types of strategies are going to have to be, more in play for crypto companies to just meet people where they are. We're probably saturated all of the degens who are willing to do all of the BS to deal with this industry, which we did, but that's we're past that point.
No, I echo that wholeheartedly. Like you see players across the stack, right? Whether it's Steakhouse Financial, whether it's Ethena, whether it's Midas, everyone is compete to power the earn function on centralized exchanges first, at custodians, and now on fintechs. To your point about broadening audience, you're seeing something similar play out with prediction markets and the Kalshi versus poly market dynamic as well. Go meet the users where they are. So yeah, wholeheartedly echo that.
Yeah, and I agree with not just saturating the crypto native users, but even the early adopters of financial institutions. The likes of your BlackRock, Franklin Templeton, amazing. But there's this huge world of other financial institutions that are not there yet, right? I think those that are the early adopters, they're there, they have done what they could. Now the challenge is how do we unlock the rest?
Yeah. Even a lot of crypto native businesses are trying to go direct, right? Like look at what EtherFi does, not quite real world assets, although someone on the fringe, but their card business and kind of trying to branch out into like a fintech yield product is a big push they're doing now. It's because I think the next phase of crypto is very much about distribution.
Okay, as a wrap up, one sentence answers, please. What should be the number one priority if there's a team building something infrastructure related? What should be the number one priority that as an industry we need to sort it out in the next year to be able to scale?
What you're building.
Trust cannot be bootstrapped. Find someone who's trusted and work with them, just like how these guys are doing with Coinbase.
I'll say read the footnotes. Everyone's showing you 20% yield risk-free. It's not risk-free. When you think about distribution and the earn function, it's not a savings account. So careful distribution is what I'll summarize it to.
Awesome. Thank you, guys.